Alright guys, so diving into the trade, we have Aussie Kiwi here. This was taken on the 24th of April for a short and it resulted in around 10.6% profit. Textbook trade as they all are. There were 3 trades in total that I took in the month of April and the month ended up around, I think it was just over 12%. I had Euro dollar was my first position, that was a loss, and then I had Kiwi CAD for about a 2.8% profit, and then of course Aussie Kiwi for a 10.6% profit as well. Now, the reason why I'm mentioning that is because trade frequency is absolutely irrelevant. Unless you're trading one pair, then you may have to focus on those metrics like your frequency, etc. Because the amount of trades you take on that one singular pair can, determine a massive amount when it comes to your edge. But if you're trading more than one market, I personally find it's just silly to be tracking trade frequency, because it's not your trade frequency that matters. What matters is if you're over trading or under trading, and there's only one way to look at that. You know you're over trading if you look back at your weekly performance or your monthly performance, let's say, to keep it simple, and you find that you've taken too many trades that you should not have taken. That's how you know you've over traded. And if you can't identify whether or not you've taken trades that you should not have taken, and that's not simple to you, you've got it completely distorted. You've got it completely wrong. Either you don't understand your system effectively enough, or your system isn't designed in a way whereby you can actually extract that information. That's a very important point to pay attention to. The other side of the coin is if you're under trading. Now, people straight away look at the number and they say, oh, I've taken 2-3 trades this month, 5 trades this month, whatever the number is. I don't even know where that number comes from. People just make a number up and they think, oh, that must mean I'm under trading or over trading. And this is why people never solve their issues, guys, because they're using silly, pointless metrics to track their performance. That's not how you do it as a trader, if you want to move forward, that is. So, how do you know you're under trading? Not the number of trades that you took. It's if you look back at your monthly performance and you see that you've missed many positions that you would have and that you should have taken. Now, if you've missed them because you weren't at the screens, you were busy, you were occupied with things, that's fine. I don't personally class them technically as missed trades because you were getting about with your life as normal. It's only missed if it was your own particular fault, in the sense of you were looking at the trade and you saw it go, you hesitated, you didn't pull the trigger, or you weren't in a strict and disciplined routine. So then even if you are occupied doing something else, it's because of the fact that you're not in a routine that you weren't sharp enough to pay attention to what's going on in the markets. Otherwise, we all have internet access, right? And we all have access to our phones or TradingView at some point. So if that's the case and you just forgot about the markets and you weren't really paying attention, that's your own fault. You need to fix up in your routine. So it's these different elements that make up if you're over trading or under trading. You're over trading if you've taken too many trades that you should not have, and you're under trading if you've missed many positions. And if that's happening frequently, you've got your answer there. Because look at it this way. Imagine if you didn't miss all those trades, what would your results now be like? You've got to differentiate between your actual performance, i.e. how you actually performed in the markets on paper, and how you should have performed. If those things, for example, the overtrading element where you were taking too many trades you shouldn't have, what if you take all those unnecessary positions out? What would your particular performance be like now? So you get my point here. So this is why, to conclude my point before I begin this trade recap, I don't look at, oh, I've taken 3 trades this month, I must be doing something wrong. I do not care how many positions the market gives me. All I care about is that the decisions that I'm making leading up to this trade, can I replicate that? And am I able to trade that at high amounts of capital? That's the question you should always be asking yourself, no matter what, because that's what it comes down to and that's what matters, right? So I'm going to dive into a few different points, but I'll do that throughout the trade recap or maybe near the end as well. So no more wasting time, let's dive into the trade. On the higher time frame, we can see that price is clearly tagged this high here at 104,400s. We've actually tapped into that with a beautiful 1-2-3 sequence here that we've got. We've got that daily high test and tweezer top formations here. We've engulfed and then we've continued to the downside. Now, what's happened here is we've pulled back and we've swung around and we've actually tapped back into an area in the market that's very important to pay attention to. So if we look at this, there's not really actually a clear point on the left, barring this one where we actually formed this continuation structure and we broke through. Really and truly beneath that, there's not much. The next point is over here. So this is essentially broken below the lows, washed people out, and then it's turned around to the upside. So from a value area perspective, we're actually playing this range here that we can see now. So that's the only context that we've got on the higher time frame. We can now remove these highs. We can see the lovely 1, 2, 3 structure that we had. We had a state of continuation here, as you can see. Right, it didn't actually complete for the 2 touch, and it just dropped, pulled back, started to do its own thing, and then it started to form larger structures. Anyway, when we break this down, where's this reverse from? Look left, always look left. Continuation, it was the first one, so price impulsed, it broke these highs. It then formed this expanding continuation. We've broken them past these structures, consolidated a little bit more, and then we carried on. So this is a key inflection area. We clearly came back into that, and we turned around. The next point of reference was this. We then broke past that. This formed a continuation to give it a little bit more fuel to push higher. It broke past down these inflection points, which are really key now, because it was from here that we had, as you can see, momentum. And that momentum carried through and broke their lows on the left. So these are very important details in price action that you've got to pay attention to, that just look like mess to most people. But when you know what you're looking for, you turn that mess into clarity. And there's a big difference, by the way, before I carry forward, between you forcing positions in the market and looking the actual facts that you see. A lot of the times, the untrained trader, the trader who hasn't trained their mental framework correctly, this is a key important point, won't be able to distinguish between that. Right? A lot of the times they'll think, oh yeah, what I'm seeing is what the market's showing me, but the market's actually showing you a reflection of your internal mindset, your internal environment. If you've got this really, really heavy bias to get involved in the market because maybe you've missed trades, you see other people scaling up their capital and you're not, insecurity basically, which can show itself in the markets. And you've got this bias to get involved in the markets for whatever reason it is. You're going to find reasons, your brain, your left analytical brain is going to find particular points in the market that are actually going to help justify that emotional state. That's the way that it works. So you'll find and you'll force particular reasons that present themselves as facts in the moment, but they're only facts according to your emotional state. That's why when that emotional state dissipates, right, and it fades away over the weekend, and you're looking back at your trades, you're like, why the hell did I take that trade? What was going on in my mind then? That wasn't even me taking that trade. Like, why did I justify that trade? Now looking back at it, it wasn't even a high quality trade. Let me know down below how many of you relate to that. There's a very simple fix to this, but I'll discuss that near the end, so do stay tuned. Anyway, so price tapped into this area on the left. We broke below. Oh, sorry, before we broke below. Let me just mark on the highs here. So it was up here that I took the trade. I've not actually got it on object tree, so I might get the profit and loss a little bit different, maybe 10.5 or 10.6. I'll try to get it the same. I can't even remember what stop I had. I think it was just around an 8.5. I'll have to load up my my broker 1 second. Okay, so I've got the entry here loaded up on my broker, so I'll add that on in a second. Anyway, the trade was taken within this continuation pattern here that we've got. Let me just remove these because we know where we're at. So the next point where I was looking at this, where this could turn around and form a larger continuation, is over here. Right? If this is going to form the left shoulder head and right shoulder, it will start to turn around these areas, statistically speaking. And if we're trading up here, we're trading at these little lows here. Now, this is where I would differentiate between taking a 2-touch continuation compared to a 3-touch. That was my risk mitigation factor here. That's the important point to get. So I know we're sat at these areas here where price can, especially with the fact that it's been coming down in an exhaustive fashion, even though that is Aussie Kiwi's tendencies, I treat most pairs the same. Now I know that's going to ruffle a lot of feathers for a lot of people because each pair does respond in its own light, and I do agree with that. But the way that we trade, we can be very dynamic in the sense that we can actually be extremely universal with different markets and different pairs. And it's a very different conversation to this video, put it this way. But the way that we do trade, you can actually trade that way across all instruments and all asset classes, and that's the very beautiful, unique thing about how we trade. But I'll discuss that in a different video in total. Anyway, so we've come through, and this had initially formed this little continuation here. If you're taking a reduced risk there, you've got to look at where you're trading into. If you took a risk entry again, you've not really got much structure there to manage. Right, you're trading within a hover, so a risk entry within a hover formation on the M15 is a little bit silly. The best thing to do here is look at it this way and think, right, if it doesn't form the 3-touch, you stay out. It either carries on to the upside or it gives you a little continuation on the way down, which it didn't do. But the way I looked at it is this. As I mentioned before, there's market psychology and then there's independent psychology. The market psychology, what is that trying to tell us here? The market's trying to speak to us in a way. That's the way I view it. And so if the market's showing me that, look, I'm forming a deliberate 3-touch continuation here, I've given you the entry candlesticks that you need, I'm giving you everything that you need here, if it was going to turn around, it would have done so when it had its chance, when it tapped in. Over here, as you can see, it's had 1 attempt and 2 attempt, but then it stayed contained within the structure. So that's like the market telling you, look, I'm not ready to turn around yet. I'm trying to find a different area to turn around at. That's the way I view it. And most of the time, right, you actually interpret the market correctly when you can get to that stage, of course. And so that's the way I view it, and it's always helped me to view it that way, because you start to learn to communicate with the market instead of trying to battle it. It's the best position to be in. So the deliberacy, the amount of deliberate structure that it's had was the very reason that I got in. I wouldn't have entertained a 2-touch here. The 3-touch lowered the risk on the position. Got involved in the pin bar. So the entry here I'm looking at was 108.805. So let's adjust that just to get it exact. And then my stop loss, obviously, because I had actually manually closed this position around about 10.6. Sorry, trailed my stop around 10.6. So it's not actually got my original stop loss on, but I'm presuming it was around 8 pips and a bit, if I can remember off memory. So it's around about there. And then the trail stopped around 10.6, which was around here. So if we look at that now, very easy management. And the reason as well, you can see that as well, look at this price action on the left. Price usually mimics that to some degree. And then I got taken out there. And then, funnily enough, this carried on dropping for a little bit. This formed this little continuation, and then off it went. If I was still in that trade for some reason, whatever that may be, and I actually got this, that would have been a scale-in position. So I would never have entertained that as an initial entry, because we've come from a very large move. A 2-touch here is not ideal. An insurance entry within that is much better. Of which, by the way, you'd have to be on very, very good management, because that could turn around for a 1, 2, 3 here. Obviously, because it's quite far down in terms of its A to B leg. Not with the bigger run. It's not far down in the bigger run, but individually looking at this, right, and looking at the price action on the left, a 2-touch would hold higher risk. And an insurance entry, you've got to watch out, because that could tag you in, drop a little bit. You hold through the trade unnecessarily and take a loss where you could have taken a break even, and this goes on to make a 3-touch. But anyway, regardless, the second trade would have been a scaling position that would have entertained around here. And then stops would have been about 10 pips. If you're going to go risk entry, go true risk entry. Likely I would have taken a break even on that. If that had kept you in, hypothetically speaking, then obviously you would have been in a totally different trade, as you can see. But that's not the trade that we're involved in, so let's leave it at that. And then price action in the end did its thing, and now it's turned around. So that was the trade. It's very simple. And to close my point off, hopefully that made sense to you guys as well. Remember, it's very easy to not look at little things such as your decision making, to think, oh, your answer is just going to be in back testing. The more that you go back and test these setups, surely the more confident you'll be when it comes to trading them live, right? It's not the truth. If that was the case, guys, you'd have made millions by now. You'd have made a lot of money. You would not be undercapitalized. You'd be passing your prop firm challenges left, right, and center, but you're not. And that's the reality. And the reason that's happening is because you're listening to what the herd have to tell you. You're listening to what every Tom, Dick, and Harry that gets a microphone in a podcast studio nowadays tells you the same thing. Same exact thing. The messages that we've been saying have not changed. Right? There's certain things, of course, I don't know yet. I've not yet experienced. I'm not the finished article. I'm not somebody who's done it all, been there, everything. I've been trading the market 7 years. I've made a lot of mistakes, right? I've been at the top and then knocked back down again, and I've had to rebuild. There's been so many different experiences that I've had. Yes, I've got many, many more experiences to give. And I will never advise people on things that I've not experienced. I would never advise people or say things that I'm not 110% confident or certain in, because I've seen it, not just within myself, but hundreds of other people that I've even coached within Falcon. And their trading's turned around from simple things. I've told them to stop back testing, get rid of it, forward test, okay, accumulate the right metrics, as I mentioned in the beginning. Forget tracking your strike rate. Stop looking at your trade frequency. Stop caring what trades I take or Abdu takes or Mark takes. Have an effective plan there, set in stone, set in place, and trade that, and then measure yourself accordingly and test in forward live time on real capital with that. Invest your money then into your funded accounts. Test through a particular protocol that we give our students. And then you learn effectively. You're not just wasting your money, you're investing your money then into your education. Education also being your evaluation, your funded accounts. Instead of what people do, or most of you guys might be doing, is just throwing your money at these prop firms, which are like brokers that are robbing you of your money because they know you're going to lose anyway, because they know people are so ignorant that even if a message is drilled down your throat, that you still won't pick it up, you still won't listen because you're arrogant or you're ignorant. Either of the two. You have to have a serious conversation with yourself if you're either one of those, because I'm telling you, if you've either one of those traits, ignorance or arrogance, you're not going to make it in this game. You're wasting your own time, and you're wasting the time of people around you, and you're wasting the time, of the people you've told that you're gonna make it to. Your future is at stake here. Don't start messing about with your future. Believe me, you will regret it. So if we're saying something, listen, because we're saying it from experience, and we're saying it because we have helped traders fix their trading from absolutely nothing and scale it up. So I'm not going to sit here and advise you things that I've not done or that I'm not 110% confident within. Get the right education. Because there's these prop firm challenges now, you guys just think, let me just save up some money, throw it at these prop firms, fail 5 to 10 accounts, and maybe on one of them I'll land it. It's not going to work that way. If it was gonna, you would have landed one by now. And even if you did, I guarantee you've given it back eventually. You've not trained yourself. You need to train yourself. You won't go walk through a jungle on your own that you've never been through, that you know there's dangers there, that you could get killed. Would you rather walk with somebody who's done that jungle 20, 30, 50, 100 times? If you say no to that, would you not be an idiot for that? Of course you would. And guess what? All of you may be saying no to retrieving the right education. And that's what my point is. It's very simple not to look at little things like your decision making, your psychology. It's very easy to just miss out things that I've said in here because you think you're the anomaly. You think you're just going to make it because you'll be the lucky one. You might not be trading the amount of capital yet. You might be trading, a couple of $1,000, couple of $100, $10,000, $20,000. It's not the same. It's not the same as trading six figures. You've also got to understand that your proprietary capital, your funded accounts, is not your money, first of all, right? It's far different to trading your own capital. It's far different to trading investor capital, but complete night and day difference. It's an amazing stepping stone, but it is different. Remember that. And the ultimate aim is not to stay with a prop firm for the rest of your life, is it? And if you think that is, you've been completely misled. Like completely. We don't tell any of our students. We have our own in-house prop firm, and we will never advise our students to say, have one funded account and stick with that for the rest of your life. The goal is to use them as stepping stones. Build your account. Don't use them as a cash cow. Build your account, properly trade them, which we train our traders to do. And those who listen do it well. And then eventually you funnel all that into your personal trading account. It's far better holding it into your personal trading account. For example, you make all the profits from your prop firm. You can withdraw that into your bank account or business account. And then from there you can just fund it straight into your personal account. It's far better to hold it in there. I would trust most brokers, most highly regulated brokers, insured brokers, better than I would a bank, if I'm honest, right? Because a bank can only insure you up to so much as well. And it's very important as well because with a bank you can withdraw instantly, and if you've got the money there you'll go and spend it. But with a broker account, if all of your profits are in there and your gains are in there, not only can you trade them now and make more money on your gains, which is so smart, whereas you can't do that in a bank, it also takes a withdrawal processing time to actually take that money out. So you can't just go and spend it on things that, in that same time you can sit and think, do I really need to spend my money on this? Guys, it's financial literacy. It's very important. It's discipline. You're not going to be told this anywhere else. We've been saying the same things. Now people are copying our messages. People are stealing our messages and saying things that we've been saying for so long and claiming it as their own. Not like I care now anyway, because those that have followed us, those that followed me, Mark and Abdu, for a long period of time, we have stuck by the same message and we always will. So guys, I hope you enjoyed this trade recap. A little bit longer, of course, as usual. And I will speak to you all very, very soon. Thank you all.